In 2007, I was a baby lawyer at PwC, and the federal government had just introduced a program called the Early Stage Venture Capital Limited Partnership. And it was designed to incentivize investment into the venture capital sector to help grow the pool of patient capital available to commercialize innovation by government pulling the most powerful lever federal government has to incentivize anybody to do anything, which is tax. And specifically, this was the first time there was a structure which recognized that one very material way to balance the risk associated with investing in the commercialization of innovation, technology companies, startups, health tech companies, and others, is to make the returns tax-free, which is basically what it did. It is designed to be used essentially by fund managers who are investing into eligible venture capital investments as defined by the tax legislation. And the logic is simple. Venture capital is high-risk, long-duration asset class, and the government recognised that the standard tax treatment was a genuine disincentive. So they created a structure that is tax-exempt at every level. Specifically, there are three tax concessions worth noting. Firstly, when you invest in an ESVCLP, you receive a 10% non-refundable tax offset in the year that you make the investment. Secondly, income distributions are fully exempt from income tax, not concessionally taxed, but completely exempt. And third, capital gains from qualifying investments, companies that are held for more than 12 months, are fully exempt from CGT, zero. No 50% discount, not the old 23.5% effective rate, zero. For 2 decades, this structure has been used as a specialist tool. Institutional money knew about it, and funds managers in my circle have been using it extensively. But now, because of the budget announcement, this is becoming a mainstream conversation. The 2026-27 budget contained 2 sets of key changes. The first set changed the broader CGT framework. The second expanded the ESVCLP program itself. So I want to deal with those 2 things in order. Firstly, the CGT discount's gone. Since 1999, for 25 years, Australian resident investors who are holding an asset for more than 12 months were entitled to a 50% discount on capital gain. For an investor at the top marginal tax rate of 47%, that meant an effective CGT rate of 23.5. That single concession underpinned the after-tax return calculations for property, for shares, for unlisted managed funds, and for standard holding of private shares for a generation of investors. But from 1st of July 2027, it no longer applies. It will be replaced with capital gains which will be subject to CPI indexation of the cost base, returning to the pre-1999 method, and a 30% minimum tax rate on capital gains, which could be as high as 47%. But when it comes to venture capital, the government was clear. ESVCLP investors are not affected by the CGT reforms at all. The full CGT exemption on qualifying investments remains fully intact. The ESVCLP has moved from attractive to structurally unmatched. But the budget didn't just create a structural advantage for existing ESVCLPs, it also expanded the program in the most significant way since its introduction in 3 important ways. But to understand those changes, you first need to understand that under the tax legislation, the ESVCLPs can only invest in certain things. Obviously, government's not just going to hand out tax concessions that are this generous without achieving a very clear public policy objective. And in this case, it is to increase the pool of patient capital into early stage venture innovation. And the definition of eligible venture capital investments is essentially how that policy objective is monitored. It includes things like an ESVCLP must invest in things that are at risk. An ESVCLP can only invest in permitted securities, which are typically equity instruments rather than debt instruments, although there are some exemptions. An ESVCLP can't invest in listed companies or pre-owned securities, although there are some exemptions. It can't invest any more than 30% of its committed capital into any one company to avoid portfolio concentration. 80% of its capital must be invested in Australian companies at the time the first investment is made. And there are a number of other rules. But there were 3 important expansionary changes that were announced in the recent budget that now allow ESVCLPs to do more and that provide a significantly greater benefit for investors than previously. The first is the maximum fund size has now increased from 200 to 270 million. This is good for our most ambitious fund managers, which means they can raise larger funds. It's less relevant directly to investors, although it does help for fund managers to have the availability of more committed capital to be able to follow on in investments in that vintage that are doing really well. Secondly, ESVCLPs can now invest in larger, more advanced companies. Previously, they could only invest in companies with total assets of 50 mil, which kind of capped the size at which you could make an initial investment. That cap has now grown from 50 mil to 80 mil at the time of the initial investment. And what this means is ESVCLPs can now back companies at a slightly larger, later stage of development without losing any of the tax concession. And then finally, the tax-free concessions applied in respect of a company to a certain point. The tax concession applied up until the point that they were worth 250 million. That cap has now been increased to 420 million. That is a very clear sign that the government intends for this program to operate at a much greater scale. The political signal here is as important as the technical one. The program has been endorsed and expanded at the same time as the broader CGT concessions have been removed. The government is telling you very clearly where it wants capital to flow. And I say, take advantage of that opportunity.